Hey, welcome back to Midnight Node.
It's late. You're probably horizontal right now, which honestly is the perfect position to learn something that could genuinely change how you think about money forever.
I'm Alex,
And I'm Cody.
and tonight we are going somewhere that makes a lot of finance people deeply uncomfortable. We are going to talk about doing nothing. Specifically, why doing absolutely nothing with your money, and I mean almost aggressively, stubbornly, beautifully nothing, statistically beats the vast majority of the most expensive, most credentialed, most overconfident minds on Wall Street.
And before you think this is some sort of lazy person's financial philosophy, I want you to know that the nothing we're describing tonight is actually a very deliberate, very sophisticated nothing.
There's a difference. A big one.
Okay, Alex, before we go any further, I have to ask you the question the listener at home is definitely already thinking. What exactly are people going to learn by the end of this episode tonight?
Right. So by the time this episode is done, before you fall asleep, you are going to understand three things specifically. First, why index funds work. Not just that they work, but the actual psychological and structural reason the math almost always tips in their favor. Second, you're going to hear a real historical story, a massive, almost embarrassing moment in Wall Street history that proves the theory isn't just theory.
And the third thing?
And third, and this is the one I think matters most for someone lying in bed right now, you're going to know exactly what to do tomorrow morning. Not someday, tomorrow.
I love that. Okay, let's start at the beginning then, because I think a lot of people have heard the phrase index fund, and they just nod along, like it's a word they know they should know, but have never really pulled apart.
Yeah, and that's actually where the psychology starts. Most people assume that because they don't fully understand something, the people who do understand it must be doing something magical, something worth paying for.
And with hedge funds, that price tag is enormous.
Enormous. We'll get into exactly how enormous in a bit, but first, let me paint the picture of the landscape, because I think the scale of this is what makes it so quietly shocking. Imagine you have two neighbors. One of them gets up at 5 in the morning every day, puts on a suit, drives downtown, sits in a room with 17 Bloomberg terminals, has a team of analysts, a risk management department, access to private data feeds, the whole machine.
Very impressive neighbor.
Very impressive neighbor. Now the other one, she wakes up at a reasonable hour, makes coffee, logs into a single account, and does essentially nothing. She bought a tiny, invisible slice of the entire American economy a while back, and she is just letting it breathe.
And who wins?
Over a long enough timeline, she wins again and again and again. Not because she's smarter, not because she got lucky, but because of something structural that most people completely miss.
Okay, but here's what I always wonder, and I think the listener is wondering too. If index funds are so obviously good, why doesn't everyone just do that? Why does Wall Street still exist the way it does?
That is the question, isn't it? And the answer is almost entirely psychological. We'll get there, but right now I want to just sit in the problem for a second, because I think the pain point is real.
Tell me the pain point.
The pain point is this. Most people feel like doing nothing is the wrong answer. It feels irresponsible, like leaving money on the table. We're wired to equate action with progress, especially with something as emotionally loaded as our financial future.
We're not wired for patience, are we?
We are deeply, structurally not wired for patience. And Wall Street knows this, the entire financial industry, and I want to be precise, I'm not saying everyone in it is malicious, but the structural incentive of the industry is to sell you the feeling of action.
The feeling, not necessarily the results.
Exactly. And that gap between the feeling of doing something and the actual outcome is where most people's wealth quietly evaporates.
That's kind of a haunting way to put it. Quietly evaporates.
It doesn't disappear dramatically, it just bleeds out slowly through fees and bad timing decisions and emotional selling, and by the time you notice, a decade has gone by.
Okay, so that's our world tonight. The gap between the feeling of smart investing and the reality of it. I'm already a little unsettled in the best possible way.
Good, because Act 2 is where we pull the curtain back on exactly how this works, the actual hidden mechanics underneath.
Let's go.
All right, So to understand why index funds work, you first have to understand what they actually are at a mechanical level. And I want to use an analogy that I think makes this really click.
Please, because the textbook definition is not it.
Okay, so imagine the American stock market as a giant ocean. And in that ocean, there are thousands and thousands of fish. Each fish is a company. Apple is a massive whale. A tiny startup is a little minnow somewhere near the bottom.
I love this already.
Now, an actively managed hedge fund, your fancy Wall Street fund, is a fisherman. He's out there with very expensive equipment, years of training, a whole boat crew, and his job is to catch the right fish, the ones that are about to get bigger. An index fund is not a fisherman. An index fund is someone who just buys the entire ocean.
The whole thing.
The whole thing. You don't try to pick the winning fish. You own a tiny, proportional slice of every single fish in the water. When the ocean as a whole grows, which historically, over long timelines, it does, your slice grows with it.
So you're not trying to be clever. You're just betting on the ocean itself.
You're betting on the collective survival and growth of human economic activity, which is a very different bet than betting on one person's ability to pick the right fish at the right time.
And that matters because the fisherman is expensive.
The fisherman is incredibly expensive, and this is the part I want people to really feel, not just understand intellectually, but feel. The typical actively managed fund charges something called a management fee. And when you hear a number like 1% or 2%, your brain just hears a small number. It doesn't feel like a lot.
But it is.
Think of it this way. Imagine your investment is a snowball rolling down a hill. Over 30 years, that snowball can become enormous, a genuine small fortune because of compound growth. Every bit of snow it picks up faster. Now imagine someone is quietly shaving a sliver off that snowball every single year. Not a dramatic amount, just a sliver. And they're doing it to the new, larger snowball each time, not the original one.
Oh, that compounds too. The shaving compounds.
The cost compounds in the exact same mathematical way your returns do. So by the time you're at the bottom of the hill, you might have lost a third, sometimes nearly half of what your snowball could have been, to fees.
Just to pause here and recap, because I think this is the first big mechanic. The fisherman is good, maybe even great, but he charges so much that even when he catches the right fish, his cut eats into your net gain in a way that's almost invisible until it's too late.
That's it exactly. And here's the second mechanic, which is the one that really stings.
Uh-oh.
Most fishermen don't even catch the right fish consistently. This sounds harsh, but the data on this is, and I want to be careful to say this in a way that doesn't feel like hyperbole, the data is absolutely brutal. Over a 10-year period, the vast majority of actively managed funds, we're talking somewhere around 9 in 10, do not beat the simple return of just owning the ocean. The whole thing. No strategy, no timing, just the ocean.
9 in 10.
And the ones that do beat it in one decade? Most of them don't repeat it in the next one, because it turns out a lot of what looked like skill was timing, or luck with a good market cycle. Or both.
So we're paying the fisherman a premium, and most of the time he's not even catching more fish than if we'd just owned the ocean.
And the fees still come out whether he does or not. That's the part that really gets me. The fee is guaranteed. The outperformance is not.
Okay, so to bridge us to what's coming next, we've talked about what index funds are and why the math structurally favors them. But now I want to know, has this ever been proven in a dramatic, real-world way? Not just in a data set, in a story.
Oh, it has. And it's one of my favorite stories in modern financial history. Let's go there.
All right, set the scene for me.
The year is 2007. And the most famous investor in the world, Warren Buffett, does something that should have been absurd. He makes a bet, a very public, very large, very long bet.
I feel like I know where this is going, and I'm still excited.
Buffett essentially walked into the center of Wall Street and said, and I'm paraphrasing, but not by much,
I'll bet anyone here that over the next 10 years, a simple, boring, low-cost index fund will outperform any collection of hedge funds you want to pick.
He challenged the whole industry?
He challenged the whole industry, and the number attached to the bet was enough that it wasn't symbolic. It was a real wager, real money on the line.
And someone took it.
A very smart, very respected hedge fund manager named Ted Seides took the bet. He selected 5 funds of funds, meaning each of his picks was itself invested across dozens of individual hedge funds. So in total, he had over 100 active fund managers working on his side of the bet.
Versus one index fund.
Versus one index fund. The boring, unmanaged, does-nothing clever Vanguard S&P 500 index fund. That's it.
So it's 100 expert fishermen with the best equipment money can buy versus the ocean.
The ocean. And the timeline begins, and something really interesting happens almost immediately.
The first year, 2008, the market crashes, the financial crisis, which you'd think that's when active managers earn their fee, right? That's when skill should matter.
That's the intuitive expectation, yes. And to be fair, in 2008, the hedge funds did lose less than the index, so they won year one by protecting on the downside.
But
then the market started recovering, and the hedge funds, because they were cautious, because they were protecting against another crash that didn't come, they didn't ride the recovery the way the index did.
they were hedged against a disaster that didn't repeat.
And every single year after that, the gap between Buffett's single index fund and the combined might of all those hedge funds widened. Not dramatically every year, sometimes just a little, but it compounded, just like everything does.
And by the end,
By 2017, when the 10 years were up, Buffett's simple index fund had more than doubled what it started with. The average of the 5 hedge fund portfolios, with all their talent, all their resources, all their strategy, returned less than half of that.
less than half.
Ted Seides actually conceded the bet before the decade was even fully over. He published an essay essentially saying, and this was a genuinely honorable thing to write, that the bet had proven what Buffett was arguing, and that the structural costs of active management make the game nearly unwinnable for the average investor.
From the guy who took the other side.
From the guy who took the other side. That is not a small admission. That's someone who runs these funds saying, the math doesn't favor you, the investor, it favors the structure.
What I find so powerful about that story is it wasn't a fringe experiment. It was a formal, public, well-documented bet between credible people. You can't explain it away.
And it wasn't a fluke market period either. It included a catastrophic crash, a long recovery, and a bull run. It was a full cycle. Real conditions.
So the theory held, even through chaos.
Even through chaos. The ocean survived. The fishermen, on net, underperformed the ocean they were fishing in.
Okay, I need to play devil's advocate now because I know what some people listening are thinking. They're thinking, okay, but that was those specific funds. Or what about the ones that do beat the market? Or this feels too simple. And I want to take those seriously.
Please, because the counterarguments are genuinely interesting and deserve a real answer, not a dismissal.
All right, first counter. And I want to steelman this one because I think it's the strongest pushback. What about the managers who do consistently beat the market? They exist. We know they exist. Doesn't that prove that skill is real?
It's a fair point, and it deserves a real answer. Yes, there are managers who have beaten the market over long periods. The question isn't whether they exist. The question is, can you identify them in advance?
Oh, that's a different question.
It's a completely different question. Looking backwards with decades of data, yes, you can find people who outperformed, but the mechanism for finding them before they outperform, that doesn't reliably exist. Think about it this way. If you flip a coin 10 times, someone in the room is going to get 7 or 8 heads. In a room of 1,000 fund managers, a handful of them are going to have remarkable 10-year runs just by the mathematics of chance distributions.
So we can't tell if it's skill or a very long streak of heads.
And the research consistently shows that past performance, even impressive multi-year past performance, is a very poor predictor of future outperformance. The coin doesn't remember what it did last time.
That's a little unsettling when you think about how much money moves based on a fund's track record.
It's the core irony of the industry. The entire marketing apparatus is built around past performance, which is also arguably the least reliable signal for future returns. It's a very expensive way to buy yesterday's newspaper.
Okay, second counter. And this one is more personal, I think, more psychological. A lot of people feel like, okay, but the market could crash when I need the money, or I'm not young, I don't have 30 years. Doesn't the timeline matter?
Yes, and I want to honor this one because it's not irrational. It's actually the exact right question to be asking, and it's where the just-do-nothing philosophy has to be applied with some nuance.
Tell me more.
The index fund strategy is not a magic wand. It's specifically powerful over long time horizons, and the longer, the more powerful. If you need your money in 3 years, the ocean can be choppy in 3 years. That's a real risk. The psychological trap here is what behavioral economists call recency bias. When the market drops, which it does periodically, sometimes dramatically, our brains extrapolate that drop forward into infinity. We feel like it will never recover.
Which is when people sell.
Which is exactly when people sell. They turn a temporary paper loss into a permanent real one. And then the market recovers, which historically it always has over sufficient time, and they're not in it anymore.
So the strategy isn't actually do nothing. It's do nothing at the moments when every instinct in your body is screaming at you to do something.
That is the whole game. That is the entire psychological challenge packaged into one sentence. Codie, that was surprisingly precise.
I have my moments.
The systemic trap is that the industry provides constant stimulation, news cycles, earnings reports, market commentary that makes inaction feel negligent. It feels like you should be responding, adjusting, doing something.
When the data says the response is the problem, not the solution.
Every trade, every rebalance, every strategic adjustment in a taxable account has a cost, a tax implication, a fee, a spread. The do-nothing investor sidesteps almost all of that friction, quietly, year after year.
I want to go back to the emotional side of this for a second, because I think this is where a lot of people get stuck. It genuinely feels wrong to not be doing something with your money. There's almost a guilt to it.
There's a word for that. Behavioral economists call it action bias. We are wired to equate action with control, and control with safety. But in investing, the evidence consistently suggests that more action equals more opportunities to make a mistake.
More chances to sell low and buy high.
Which is the opposite of the goal. And the fee structure amplifies every mistake. So the irony is, the feeling of safety that active management provides, it's actually a psychological product. You're paying for emotional comfort, not necessarily for returns.
That might be the thing that stays with me longest from this episode. You're paying for the feeling. Okay, I think we have to get to the action plan now because I do not want to leave someone lying in bed feeling informed but stranded.
Agreed. Let's talk about what this actually looks like depending on where you're starting from. Before I give the specific steps, and I want to give really specific steps, not vague platitudes, I think we have to acknowledge that this strategy doesn't look the same for everyone, and your starting line matters.
Say more about that.
If you were starting with something small, say a few $100s, maybe even less, the index fund strategy is arguably even more powerful for you than for someone with a larger portfolio, because you are building the habit at the same time you are building the asset.
The habit is the head start.
The habit is the compound engine. Someone who puts a modest amount in automatically every single month without thinking about it, without checking it obsessively, and does that for 20 or 30 years, the math on that is genuinely life-changing.
And if you're starting with more, say you already have a meaningful amount sitting somewhere.
Then the most important question becomes, where is it sitting and what is it costing you to sit there? A lot of people with larger amounts are in actively managed funds they inherited from a financial advisor or from a previous employer's 401k, and they've just never looked at the fee structure.
The set it and forgotten it problem.
Right, and sometimes a quiet fee audit of an existing portfolio reveals that you've been paying significantly more than you need to for a very long time. That's the leverage point for someone starting from a larger base.
Okay, so give me the 3 micro actions. Tomorrow morning, specific.
3 things, ultra-specific. Here they are. First, open whatever account you use or have been meaning to open and search specifically for the expense ratio of whatever fund you're in or looking at. The expense ratio is the annual cost of owning that fund, expressed as a small percentage. If it's above 0.5%, half of 1%, write it down and compare it to a basic total market index fund.
Just look at that one number, the expense ratio.
Just that one number. That's the whole assignment for step 1. You don't have to do anything yet, just look. Second, set up or check if you already have an automatic contribution. Even a very small one. The size is not what matters at the start. The automation matters. When investing is automatic, it removes the moment of decision, and the moment of decision is where emotion creeps in.
Remove the decision. Love that.
Third, find one person in your life, a partner, a sibling, a friend who cares about their money, and just mention what you heard tonight. Not to lecture them, just to say, hey, did you know about the Buffett bet? Because teaching it is the fastest way to genuinely understand it yourself, and understanding it deeply is what makes you hold on during the scary moments.
That third one is sneaky. I like it a lot.
It's a memory consolidation technique disguised as generosity.
Of course it is. Alex, this was genuinely one of my favorite things we've covered because it's not complicated, it's counterintuitive. And counterintuitive things that are actually true are the ones that change how you see everything else.
The ocean doesn't try to outperform itself, it just grows. And if you own a piece of it, you grow with it.
That's the whole thesis, right there.
That's the whole thesis.
Now, I have to ask, because I know you've been running the numbers in your head this whole time, if index funds are this powerful, what does it look like when you combine them with something else? Like, what's the next layer?
That's actually a perfect setup because tomorrow night, tomorrow's episode, we're going into tax-advantaged accounts. The difference between owning the ocean in a taxable account versus owning it inside something like a Roth IRA or a 401k. Because the tax wrapper changes the math in ways that are almost as dramatic as what we covered tonight.
Same ocean, different container.
Same ocean. And the container matters enormously. So if tonight was the foundation, tomorrow is the first floor.
Subscribe so you don't miss it. Seriously. Because what we're building this week is intentional. Each night is a layer, and by the end of the sprint, you'll have a complete picture.
It's worth staying for.
It's very worth staying for. Okay, go to sleep, rest well, let this settle.
See you in the next node.